So in this session, I'm just going to explain about the merchandising operations, and I'll explain about what is the inventory system with lots of examples. So I will be covering what is the importance of inventory, what are the types of revenue, operating cycles of merchandiser, and the difference between periodic inventory system and perpetual inventory system, and also the general entries related to the purchase and sale of inventory, discount received, and sale and purchase return. So what is inventory and why this is important for all the organization? So buying and selling of inventory plays a very important and big part in the success of any organization in the world. In this section that we will learn how to record the purchase and sale of goods as well as evaluating how companies make decision about pricing and stocking the inventory. Money can be generated in two ways, the service revenue and sales revenue. Service revenue is related to providing the services and getting money from the customer. Sales revenue is providing the goods, means commodities that you can see and touch to the consumer and receive money out of that. That will be known as service revenue. Now, if we talk about here, the earning of revenue by providing the services maybe from the hotel industries, airline, physicians, lawyer, public accountant, cutting of lawn in your neighborhood, or maybe cutting of hair. Revenue can be generated from selling of the product or article that can be clothing store, right? Selling of grocery items, gas stations, Canadian retailers, Hudson Bay, Canadian Tire Corporation. These are the name of few. Even the Shopper Drug Mart, they sell a lot of products, BlackBerry Limited, Walmart. So merchandising entity earns its revenue by selling products called merchandising inventory, which is known as MI, or simple, you can say inventory. So how we can calculate the net sale? When we refer to the company sale, we are offer are referring to the net sale. It means sales minus sales return. That will be the net sale at the end of the period on 31st of December. So how to calculate the cost of goods purchase? I'm talking about the purchase. When company buys some goods, buys some article, right? Maybe laptop or other electronic devices that the Best Buy is getting or purchasing, whether cash or credit, it doesn't matter. So we're talking about the inventory management. Let's say ABC handbag company, they have purchased some of the articles, handbags. So cost of the handbag is 100 and custom and duties paid to the Canadian government is 10, shipping charges that is $5 and insurance during the transportation is 2. So 117 is the cost of one article, means one handbag. So now what is the operating cycle of the merchandiser? Step 1, 2, 3. So first is the purchasing of inventory, second is selling of inventory. When they sell inventory, the account receivable that will increase. It means debtors will increase. And later on we collect money from the from our customers. So when we collect money from the customers, it means cash is received. Again, what we do with the cash? The companies spend cash again for purchasing of the inventory, step 1. Then 2, 3, again step 1. So this is what? This is accounting or operating cycle of merchandiser. Inventory system we have periodic inventory system and perpetual inventory system. So periodical inventory system is the record of inventory at the time of sale is made and cost of goods sold is calculated at the end of the period. Periodic. So in the periodic inventory system, the cost of goods sold will be calculated once in a year, mostly at the end of the period. But perpetual inventory system is different. In the perpetual inventory system, whenever the goods are sold, on the same time, the cost of goods sold is also calculated, right? At the same time. It means the stock will be up to date all the time. Take an example of Home Depot. When you go to the Home Depot, they have some devices. The salesmen, they have devices in their hand. They have a computer setup system. They have an inventory setup system very efficiently. So whenever they are selling some of the article, maybe washer or dryer, or maybe some paint or anything, automatically there the cost of goods sold also be calculated in the system. And also the remaining stock will also be reflected. So this is what the perpetual inventory system works. Periodical inventory system is inexpensive, right? For the inexpensive goods. and very small grocery items, right? Grocery stores are there. Uh, then they don't have to have some optical scanner or a POS, means point of sale. They calculate inventory at least once in a year, maybe once in a quarter, right? Maybe from 1st of January 2020 to 31st of December 2022. This is the counting period. At the end of the period, they count inventory physically. That is the periodic inventory system. For example, uh, at the beginning stock is $42,000. Cost of goods purchased, we have added it, and ending stock that we have $22,000, which is calculated, which is found in the store, and cost of goods sold, that will be $30,000. So this system is being used very less and less, since most businesses have computerized their inventory records. On the other side that I discussed, the perpetual inventory system, no need to calculate the cost of goods sold, because the cost of goods sold is recorded every time the sale is made automatically. So take an example of automobiles, take an example of jewelry and furniture stores. Sometime counts the inventory on hand at least once a year. Sometimes they count, sometimes they don't count, because all the time they have the cost of goods sold updated in the system. How many units were purchased? How many units were sold? Right? The quantity of the inventory in hand, everything is calculated. Like Home Depot and IKEA is one of the example. Now, start with a journal entry. It's very important. We as a business, that we purchase some article, purchase some goods. When we purchase some goods, we always do entry. The purchase or inventory account debit, $40,000 for example, and account payable, 40,000. So this is account payable only in case when we have purchased on credit. If the same example, everything same, but we have paid money, like the cash is given immediately. So purchase or inventory account debit to cash. So this is the normal transaction every time that we do. Now, if there is a quantity discount, let's say option A, option B, two options we have. So option A say if that our company buy two jackets and discount will be 5%. If we buy 3 to 10 jackets, then discount will be 10%. So let's take this example and we have opted option B. It means 3 to 10 jackets that we have bought and $1,000, that is the costing of these, and 10% discount that we have received. So once we say that inventory has increased in our system, in our office, in our warehouse, then definitely it will be debit, because this is the real debit what's coming 1000. Or uh, second week, if we consider this as expenses, for example, if we say this is a purchase is expenses, for example, and debit all expenses and losses, even then this is okay, no problem with that. It all depends upon us how we interpret it. Cash has gone $900 because 10% discount is 100 that we have received. So discount received is an income. So this is a credit. According to the rule of debit and credit in the nominal, so debit all expenses and losses, credit all income and gain. So in this case, we are going to credit it because this is the income. So $100. Now, sometime we have a percentage discount with the due date, right? So percentage discount is, for example, here on 20th of April 2023, if the payment is clear in 30 days, right? This is the credit period, we say 30 days credit period. If we have bought something and on credit and we payment is made within stipulated time, then the 5% discount will be given to us. So in this case, in this scenario, in this example, so what I have explained, the purchase account debit or inventory account debit $40,000 and two accounts payable. So we have bought goods on credit. Now, at the time of making payment, let's say that we are making payment within 30 days. So 20th of April and 15th of May, it means around 25 days, within 30, less than 30 days. If our company is going to make a payment, and definitely we will get discount of 5% of 40,000, that will be 2,000. So account payable, account debit, right? It was credit before. Now account payable, account debit $40,000. Cash has given from us, cash has gone from the business, and discount is received 5% 2,000. That will be considered as the income. So this is how we calculate the percentage discount with the due date. So now if in case we buy something and we will return something, like for example that I'm running my own company, electronic company, so I'm going to refund something, some of the articles, some of the laptop or mouse or a keyboard or mobile phone are not working properly, and we have a return policy. For the businessman, return policy is there, so I'm just going to return some of the things. So how that I will make entry? For example, if your customer paid in cash, you are physically received the money at the point of sale. So now you need to decide how you are refunding the customer, cash or credit. So first is, if we return that goods, we have taken that goods which were already sold to the client and have given cash. So in this case, what will happen? Sales return and allowances account debit to cash. So cash has gone from us. Now, sometimes the store or our company don't give cash but give some store credit, maybe some card, points card, in which the money will be stored. So we can take an example of a marshal, right, or winner. Winner normally give cards. They don't give refund anything. They give card, and in that card they store some money. Even the Best Buy does same thing. So storing card. So sales return and allowances count debit to account payable in that case, if it is store credit. Now, this is if the case is like purchase return on credit, then what will happen? So credit purchase, when we have bought some goods, then purchase account debit to account payable. So in case of credit purchase, the following double entry must be made upon the purchase return. Accounts payable account debit to purchase return. So this is the entry that we will do. So it means what I did the opposite of this. The first was a purchase account debit to account payable. Now account payable account debit to purchase return. Right here it was purchase, now this is purchase return, because at the time of making a profit and loss account or income and expenditure account, if there is a purchase, we will write a purchase minus purchase return, so that will be net purchase. So now one example that I'm just going to show, bike Ltd purchases a mountain bike from BMX Limited. 4,800 is the amount of those bike on credit. Bike Ltd later returns the bike to BMX Limited due to a serious defect in design of the bike. Initially, the purchase will be recorded as purchase account debit to BMX Limited or accounts payable. Upon return of the bike, then that will be the BMX Limited account debit to purchase return. As I mentioned in the previous example, this is one more example that I have set up for you. Now, purchase return. Now, purchase, we are going to return some cash. So, in case of cash purchase, the following double entry must be made upon the sales return. One more example. Entry for the cash purchase will be purchase account debit to cash. It means that we have received goods and cash is paid. One thing. Now, return of goods. Account receivable. Account here, in this case, what is happening? So, account receivable will be the Best Buy account debit. So this is the second entry that we are going to do here. So goods they are going to return. So in this case, the defective merchandise returned to the Best Buy. Account receivable account debit to purchase return. So next we have here the entry for the cash received. So cash account debit to account receivable Best Buy. So cash received from the Best Buy for goods returned. So these are the three entries that we have done. So we have learned the difference between periodic inventory system, perpetual inventory system, and general entries related to the purchase and sale of inventory, discount received, and sales and purchase return.